Again, we want to thank you for being on this call today with Monica Rebella, CPA and President of Rebella Accountancy, which is a CPA firm that specializes in tax and accounting and consulting services for hundreds of dentists in California. The topic of our call today is 2014 year-end tax planning. If you're not a current client of Rebella Accountancy or you have not met her yet, Monica Rebella is a CPA and has 26 years of accounting and tax expertise, which includes 13 years working with Big Four, Big Eight firms and over 13 years experience working with dental practices. She is a past president of the Orange County, Long Beach chapter of the California Society of CPAs and is a member of the AICPA. She has conducted training sessions for accounting firms as well as lectured on tax and business matters to the California Society of CPAs, UCLA Dental School, and the Orange County Dental Academy. She runs her own firm in Tustin, California, providing accounting, tax, and consulting services for over 300 businesses throughout California, specializing in dental offices and small businesses. Monica, welcome to the call.
Thank you, Jeff, and thank you to everybody on the webinar tonight or might be listening in the future. We are going to talk about 2014 year-end planning. It is just before Thanksgiving here and certainly time that we put our year-end thinking hats on. So we're going to go into what we're going to cover tonight. So tonight we're going to talk about the year-end tax planning, year-end purchases if you want to make some still to get some tax deductions here. We're going to talk about the 2014 tax law changes because we certainly have some. And there's some final things here about just 2014 issues before year-end that you may or may not be doing but do need to get done and accomplished before the end of the year to take advantage of or make sure we just do it all properly. So let's get into our first slide here for year-end tax planning. First thing I want to talk about that is overlooked a lot of times, which is home office deduction. So the home office deduction, if you're not a corporation, is something that you take on your personal tax return. But if you're a corporation, specifically if you're an S corporation, to be able to take this deduction, you now have to complete all of the information and have your S corporation actually write you a check by December 31. It's an office expense that needs to be reimbursed to you personally. So you would calculate all the components of home office deduction, which is the square footage of the home office area to the total square footage of your home, and that gives you a percentage. That percentage is applied to your mortgage payments, your real estate taxes paid, your utilities paid, as well as the insurance on the home and any other specific expenses that might be incurred there. So it's quite a little calculation. We do it for our clients, and we do it for some of our tax clients as well. The biggest is that you've got to get a check cut back to you by December 31 to be able to take this deduction in the S corporation. The old days, we actually calculated this deduction and we added it to the tax return for the S corporation of really a sole owner of an S corporation. No more. It now has to be a check written to the owner by the corporation. Here's the other thing about home office. The area you say that your home office must be exclusively used for business. So you can't use your dining room table because it's not exclusive for business. You're going to be clearing that off and having the family dinners there. We've got a big Thanksgiving coming up. It can't be the kitchen counter where you're doing a lot of other things. So it can't be a space that also is used for all of this, but when I can, I use it for my home office. It's got to be exclusive for the home office business use. The other is a little twist here that's come about recently. Home office deduction needs to be for the benefit of the employer. So even if you own your S corporation, you are an employee of the corporation. So this would be for the benefit of the employer that you are working from home. You really need to do things there and you need to decide what those things are. I do all my administrative stuff having to do with the employee records, reviewing x-rays, writing up different things. You actually have to decide what kind of things you're going to do from home, and then you need to document those in your corporate minutes. And why do we want to do that? Well, on the next slide, we want to do this because it allows for the time you leave your driveway to wherever you're going to be a business trip. So the minute you leave your driveway and you're going on a business trip, that's where you start the calculation. You don't have to go to your office and then start calculating mileage, because otherwise it's considered somewhat of a commute from your home to the office. But if you're home office and you're doing it for your employer, it's at their benefit that you're working from home. The minute you leave your driveway to the time you get to your office and other places you go, those would be business related, and it would start from your driveway as long as it is a business trip. So the second item I want to talk about here is the company holiday lunch. It's coming out here at the end of the year. You could actually do retreats in the middle of the year. The company lunch, as long as you're discussing business, is not a meal and entertainment expense. Okay, as long as it's for business and you're talking about the practice, you're talking about the business, it is not a meal and entertainment expense. It's an employee benefit. The big reason you want to make this distinction is that employee benefit, when you're doing it, holding it, and you're talking about business through this lunch period and you're paying for the lunch, it doesn't get a 50% reduction. You get 100% of that deduction rather than what we normally get for meals and entertainment, which is 50%. So it's important to make that distinction. However, you got to document. You have to provide and document with the receipt, document somewhere that this was a staff meeting and who was there and what you talked about. Okay, the third item I have here is team building sessions. There are a lot of practices that do team building sessions. You could do it at a beach house, a ski lodge. You could go out scuba diving. You could have a backyard barbecue. All of these things can be deducted as long as there was a business meeting and you document who was there and what you talked about. Document. People can overlook this, but we want to make sure that we're keeping our documents on it. So the next item I have here is antiques as furniture in the office. So there is a great way to build your own personal wealth if you're into buying antiques and collecting them, is that you could put them into the practice, into the business, and use them in the business in an office that you might have or in a consult room, and those are now business expenses. So we get a deduction for them, and they're actually adding value for you. The next item, two items, are credits. So I put this in here because I remind people that if we are in high tax rates these days, so retirement plans are incredibly important at this point. We want to defer income and defer paying at these high tax rates till sometime much later when your tax rates come down. Creating a new retirement plan, there is a credit for that. So if you don't have it or you terminated some and you're thinking about it again, we've got a credit for new retirement plans. The second credit that's on here is the credit for small employers for new health insurance plans. So if you have decided to go ahead and get a plan, there is a credit for providing health insurance to employees. It's a very complicated calculation, but I can tell you for the clients that I have calculated for that dental practices, it doesn't work because there's two prongs. One is that your employees can't make over $25,000 annually, and the other prong is that they can't work more than a certain number of hours. So when we start looking at dental practices, which are a lot of my clients, we find that people make over $25,000 on average for the people that we have to count for it, and the number of hours that they work are high. So when we look at it, there's little or no credit, in most cases no credit, but it does exist if you can meet all the requirements. So let's go on to our next slide. Now we're going to talk about, okay, what can I buy here at the end of the year? What can I do to pump up deductions? So we talked about some deductions: home office, the credits, the business, the lunch meals, the team building sessions. Now we're going to talk about something still to buy before the end of the year. Well, in 2014, the Section 179 deduction that was at $500,000 was not extended, so it went back to where it was, which is $25,000 for the entire year. It does not look like and will not probably happen that that's going to change. We're just too close to the end of the year to make much of a dent of them changing it. So we're at $25,000 of buying new equipment for 2014. If you haven't hit the $25,000 level, you certainly might want to look at whether you want to do that for 2014. Of course, we get the deduction in 2014. If you've already hit that, you bought some new computers, you bought a digital x-ray, you've actually a new autoclave or whatever you might have done, and you've already hit that amount, we still get the deduction. But we get the deduction in depreciation, which will go over 5 years or 7 years, depending on what you bought. So it's a much smaller amount. We're all disappointed with that. Congress didn't act, but we'll still get the depreciation deduction over 5 or 7 years for what you might have bought that's over the $25,000. So I get this call a lot about buying a new car and SUV. Can we still get these great deductions? So the answer is yes. We still have the ability to write off these things. Just to remind everyone of the rules, when you're buying a new car, if it's not over 6,000 pounds, you're in what's called the luxury automobile rules, which the IRS has set out how much per year you get to depreciate if you use your car 100% for business. And I didn't put this in here, but I want to stress this. Very few people use their cars 100% for business. And we have to start being mindful of that, is that there is a percentage of personal use on our cars in business, and we have to acknowledge that, both in the depreciation as well as the gasoline, the insurance, the AAA, et cetera. It's not 100%, and we need to acknowledge that. So if you do buy a car, if you buy an SUV, and those are the ones that mostly get over our 6,000 pounds. This one says 600 pounds. I apologize, the slide's wrong. It's 6,000 pounds. Then we get to deduct $25,000 in the first year if it's 100% business use. And again, very rarely is that it. And if you're under 6,000 pounds, then you get the regular depreciation. And it's pretty small. It's about $4,000 a year if you buy just a luxury car, which is pretty much anything but a Kia, a very low-level Kia. So it pretty much is all cars. Now, a lot of clients say, but it's really expensive. I just bought a Tesla. Well, Teslas are great, but they're not over 6,000 pounds. There is a credit for buying a Tesla. It's $7,000 in the first year, and a credit is a dollar-for-dollar offset of tax. A deduction is not. A deduction is based upon what tax rate you're in. But the problem with the Teslas, they're over $100,000. The IRS says that you can only get about $4,000 a year in depreciation on it at 100% business use. You will never be able to fully deduct that car. Now, everyone says you're going to pay less gas, it's electric. That's all great. That reduces your tax deductions, and you're limited on the deduction on the car. So it's not a great business vehicle, but that's not what drives everybody to go and buy a new car. No pun. For 2014, there is no bonus depreciation. For the last several years, we've had the ability to get 50% of the original cost of assets we put in place if they're qualified for this bonus depreciation. We got 50% to 100% write-off with this bonus depreciation. It is gone for 2014 as well. It did not get extended. So we're going on to the next year. So more year-end tax planning here. This is kind of just an overview of where we are and what might you still want to do before the end of the year. It's incredibly important to monitor your income in the last months of 2014 because of our high tax rates and what happens when you hit certain levels. And the other is, will you take 2 weeks off at the holidays? What will you do about taking some time off? If we know 2014 is a high income year for you, you're going to definitely want to accelerate expenses into 2014, prepay what you can by the end of the year, including prepay your CPA. That would be good. Prepay your rent. If you've got lab bills, dental supply bills, prepay those things. Because here's the thresholds, the first thresholds before you start hitting some new taxes. It's $200,000 for a single person or $250,000 for married people. So if you're going to hit these thresholds and go beyond them, you might want to look at accelerating expenses. If 2015 is going to be a bigger year with income, then you're going to want to move those expenses to 15 so that you can bring, again, the taxes down. Business promotion, this is a misunderstood expensive versus charitable contributions. So I want to clear up the air here. Business promotion is different from making a charitable contribution. might be making a charitable contribution. However, if the charity will acknowledge you publicly in some way for your donation for the business, that is a business promotion. You get 100% of that as a deduction. A charitable contribution, on the other hand, goes on your personal return if you're an S corporation, and you're already going to have it reduced if your income goes over these certain levels. So the business promotion is much better because it's against the profits of the business, where a lot of things get calculated, versus a charitable contribution if you're an S corporation coming to your personal return and potentially be quite limited. Now, when I say the charity needs to acknowledge you and the business in a public way for a thank you, it can be at a gala event and you're printed on the program for the night. It can be a sign that they put out there with your name on it, as long as you take a picture of it or ask them to take a picture of it for you. I can tell you on the radio stations that do certain things, like I give money to K-Jazz, they will actually announce you on the air, thank you for your contribution, your company name, and you ask them to get a little transcript of it, and then they will give that to you. So any public way can be any of those things, as long as they are acknowledging your name in some way in their newsletters, etc. That would be great, and we'll get a better deduction for that. If you just have a patient that comes in and says, my kid's soccer team needs trying to buy new uniforms, would you be willing, and you give them $25, that's not going to help. Okay, if you're truly just giving a charitable contribution, and that's what it is, and that's still a good thing to do. My other item here is to make sure that all your personal out-of-pocket expenses for the business are being reimbursed to you. A lot of people spend their own money for business deductions and just say, oh, yeah, I stopped at Office Depot or Staples and I was getting a few things for the kids and I realized I needed to get this and this and this. And you paid for your own business and your own personal credit cards or with check or with cash, and you forget, okay? So you might keep the receipts somewhere. The best thing is, by the end of the year, you should add up all your receipts, determine if it's supplies or dental supplies or whatever it might have been, and make sure the business writes you a check for all those things. I have found with some of my clients, it can be as high as $4,000 if you're keeping all those receipts. Because remember, when we go to the ATM, we take out money, and the next thing we know, we have no money left. But you went and spent it places. So, it includes parking for business. It includes receipts for different supplies and things you do. It can be a variety of expenses that you want to make sure the business reimburses you for. Okay, so let's go to our next slide, more planning. I briefly alluded to this, retirement plans, so important because of the high tax rate. So if your income is going to go over $200,000 if you're single, or $250,000 if you're married from the practice, from your business, retirement plans are incredibly important. So if you don't have one, please talk to your CPA, your tax provider, and see if they can run some calculations to see if they're going to make sense for you. Do your children help you in your business? Okay, this is a big one. Do you give them salary? If your kids really are working in the business, they really have a legitimate thing that they can do for you and are doing for you, you can pay them, right? And it doesn't always need to be a paycheck. You could actually pay for things on a credit card for them or other things and add them up, and that becomes their compensation. You might pay some payroll taxes on that, but you're going to pay them anyway. So there's a way to compensate your kid for things, their children for things that they might be doing to help you out in the business, and you just have to gross it up to make it salary and take the deductions. Other times you can actually pay them a salary has to be, if they're just going to put labels on the new files. If it's really simple administrative work, you have to be careful about how much you pay them per hour for that. It does have to be commensurate with what they're doing. But it's a great way to get a deduction where you're shifting the income to the children for the work they did. They're at much lower tax rates, or maybe zero tax rates, versus your incredibly high tax rate. So make sure that you're thinking about that before year end. Here's the biggest thing, and I don't see it happening with my clients very often, but there is a zero capital gains rate, which is rather astounding, right? A zero capital gains rate, no tax on long-term capital gains rate if you keep your total income to certain levels outside of the capital gains items. So if you can keep your income to $72,000 or less if you're married, or under $36,000 if you're single, excluding the capital gains item, you won't pay any tax on long-term capital gains. It's pretty amazing. So, and that's qualified dividends as well. So it's pretty amazing. Stock gains on sales of assets and carryovers. Again, this is working with your financial advisors. If they're going to sell things, we want them to look for ones that are losses, so we can make it somewhat neutral between gains and losses for this year because, again, we got such high tax rates. Long-term capital gains, though, are still pretty awesome. You have to get to $400,000 of total income before you go from 15% capital gains rates to 20%. But look, if you're at $400,000, you're going to be hitting the 39.6% tax rate. So even 20% for long-term capital gains is a pretty nice differential. The last thing I have on this slide is donating stock with high value to charities. A lot of people know that they want to give something to charity, and this is kind of a nice way to do it. You will not pay any tax on the appreciation of the stock. Okay, so you won't pay any tax on that. You give the stock to the charity at the full market value of the stock, and you get a charitable contribution for that appreciation in the stock. So no tax on the appreciation, and you get a tax deduction for the full increase in value of the stock. Why I'm bringing this up is because we have this thing called the net investment Medicare surtax, which started last year. It's the NII tax through Obamacare that taxes you on gains, capital gains, as well as interest and dividends. So this is one way to keep that gain from the stock from hitting your tax return and getting you a deduction for it if you don't need the money. So it's something to consider. So let's go on to the next slide, which is more year-end planning here. Retirement planning, fund it to the maximum. I am seeing people who have 401k plans and they're not maximizing the 401k plan. You can do $17,500 a year to the 401k plan. If you're over 50, you get to add another $5,500. You get to get to $23,000 that you can defer your wages until later in your 401k retirement plan in your name. I see so many people that are well below that, and there's no reason we need to do that. Now, we only have a month left. It's hard to fund it all in the last month, but you can. I just think that that's a huge missed opportunity. The next one is the HSA plan. Aren't HSAs awesome? I mean, where else do we get a tax deduction for money we put into a health savings account, and then we can take it all back out tax-free if we use it for medical expenses? And you don't have to take it out the same year you put it in. You can keep accumulating money in there, and if you want to, it can be a retirement plan. So it's an awesome thing. Now, what I will say that there are many changes in healthcare, many changes in insurance. There are many opportunities with HSA that may no longer exist. So you may have a health insurance plan now that you can't have a health savings account for because it has to go hand in hand with your health insurance. It has to be a qualified, high deductible health insurance plan qualifying for a health savings account. If it doesn't meet those requirements, it's not a qualified health savings account, high deductible insurance plan, you can't have an HSA. If you're in Medicare, you cannot do an HSA. So there are now some more restrictions around HSAs. Children under 24, give them appreciated stock. Here's another thing about children, is that they have very low tax rates. And remember, I just went over, if you keep your income to $72,000 if you're married or $36,000 if you're single, you'll get a zero capital gains rate. That's true for children. So there's a way to gift to your children some appreciated stock. They could sell it and pay no tax on it. Now, in saying this, there are gift tax issues around this, gifting things. You can gift anybody $14,000 a year, no strings attached, no reporting. Two parents could give $28,000 in appreciated stock to their children a year. So you do have to look at that. If you go over $14,000 a year per person, we have to report it, and it goes against your estate, right? So it reports. You don't necessarily have to pay any tax. It just goes against your estate exclusion, which right now is $5,325,000. It's a big number. it would go against that. So your estate exemption before you pay estate tax goes down, but it definitely might be something to look at. This last one here, I'm always very cautious about. Use your credit card for last-minute expenses at the end of 2014. I wouldn't want you to go overboard on this by any stretch of the imagination, but you get a deduction when you charge things on the credit card, not when you pay the credit card. It's a very interesting thing in the tax laws that we actually get the deduction at the time of purchase, not necessarily that you've paid it. So credit cards are a way to do some expenses, accelerate your expenses into 2014, but be aware you're still going to have to pay the credit card off. Okay, let's go to our next slide. So I alluded to the fact that high tax rates, they're coming in at different income levels. So let's talk about that a little bit. So the first one, and I had mentioned previously, is that you've got the new net investment income tax, and it's on people that reach go over $200,000 if you're single, or $250,000 if you're married. This tax is based upon interest, dividends, capital gains. So it really can hit you in a very, very tough way here. The tax isn't huge, but it is layered on to your income. So it works like this, and we'll go over a little bit of it later just quickly. But if you have $30,000 of interest, dividends, and capital gains, and you have income of $300,000, okay, you've gone over and you're married, you've gone over the $250,000 by $50,000. You've gone from $250,000 to $300,000, but you only have $30,000 of interest, dividends, and capital gains. You will pay the net investment tax on the $30,000 of interest, dividends, and capital gains because it's less than the $50,000 that you went over $250,000, okay? And it would be at a 3.8 rate. So it's not a huge tax, but it is, and that's the first level of where we start getting hit with higher taxes. The next level is when you're hitting $400,000 if you're single and $450,000 of total income if you're married. A lot of things happen when you get to these levels. Number one, you lose your personal exemption. So for being breathing human beings, you lose all of that for yourself, your spouse, and your children. The next is you start losing your itemized deductions, your mortgage interest, your real estate taxes, your charitable contribution, et cetera. All those start getting reduced, and to the point that you could get to 20% of those, but you would have to have very near $1 million in total income to only be at 20% of those. But that's how drastic it is. So we do want to plan around here at the end of the year. Where are you going to be? If you were lucky enough to say, I'm going to go well beyond that, great. You want well beyond it. Make sure you're maxing retirement plans. Make sure that you have looked at all these other things. But you are in it, and we just deal with the fact that you're in there. But get those retirement plans going. If you can still work around this, I would say try not to get over these limits. And when I say total income, I mean everything on the first page of your tax return. So it's not just the profit from the practice or your wages. It's interest, dividends, capital gains, retirement money, Social Security, rental. It's everything that would be on the first page of your tax return. So keep that in mind. Let's go to our next slide. So this is our second year of the net investment income tax, as I alluded to. It's a 3.8% tax on interest, dividends, capital gains, but not tax-exempt interest. That does not count in there. And it does count for rent as well for people. So again, we've talked about these thresholds and this tax. Let's go to our next slide. Here's the example, but I gave you one, but just to see it in writing. So we got a married couple with income of $390,000. They have $20,000 of interest and dividends. They'd be subject to this net investment income tax of 3.8% and the Medicare surcharge tax. So what we've come up with here is that they're going to have a tax on $1,260, which would be the first calculation for the Medicare surcharge tax, and 3.8% on the interest and dividends of $760. We'll go to our next slide. Their total additional tax on this is $2,020. So you can see their total income was $390,000. Their new tax is additional $2,020. We haven't even, when they didn't reach $400,000 or $450,000. So this is the extent of the additional Obamacare taxes. So our next slide. I'm not going to go over all of them, but there are more if you choose to read more on these slides. So I'm going on to slide 16 now. 2014, we have new rules around repairs and supplies. This applies to our businesses. This applies to rental properties. I did talk to people about this last year for year-end planning to make everyone aware this was coming for 2014. It's here and it's now and it's final. We have been kicking around with the IRS for 10 years. We haven't liked anything they've come across. We didn't like this either, but they decided this is where they stand, and they drew the line and said, we're final on this. So it has to do with repairs and maintenance and supplies. Incredibly complicated. It has to do with, we'll start with supplies. For businesses and for rental properties, if you buy a supply that's $200 or more per item, and it will be consumed in 12 months, you can completely write it off. However, if the single item that's $200 or more will last you more than a year, you actually have to now treat it like buying a building, like buying something very long asset. You have to what's called capitalize it and write it off over 5 to 39 years, depending on what it is that you purchased. $200 per item. So can you imagine big businesses trying to track this? It's mind-blowing here. Okay, let's go to our next slide. So it's simplified for small businesses with assets under $10 million. Okay, so if you have rental property and that property is under $10 million, great. And this is on the repair side now. We went over supplies, got an understanding on the supplies, but now we're in repairs and maintenance. So if you've got a property that's under $10 million and you have repairs and maintenance of $500 or less, those are great. They're still repairs. No problem you need to do. The caveat here is that it needs to be redone more than twice in a 10-year period, time you did it, and one more time, and then you can write it off immediately. Okay? But if you have a repair that you had the plumber come in and all of a sudden you realize you need a new toilet, and while you're there you're going to do new flooring, and then you decide, what the heck, let's put in a new sink. Now it's a project, and all those expenses come together. So where the toilet might have been under $500, you have to take it all together as a project, and now it's over $500. Again, now the caveat is if you're going to replace all of that stuff at least one more time in a 10-year period, so twice in this 10-year period, the time you did it, and one more time, you can write it off right away. But you better have records that show you are constantly doing that over and over at least twice in a 10-year period. Okay? Otherwise, that $500 item or whatever it comes up to, again, we capitalize it like we do buildings, etc., and we have to write it off between 5 and 39 years, depending on what it is. So go to our new slide on 18, improvements. So there's a lot of new definitions around repairs. And basically, I'm just going to break it down to the nut here because there's a lot of stuff to read. If it's a betterment, if it's in the improvement, it's going to make the property better than it was, it's going to adapt it to a new function, is going to bring it back to its original use and function, it's going to be capitalized. You're going to have to, again, set it up like a long-term asset, and you're going to have to take the deduction now over, again, that 5 to 39-year period. With improvements, it's typically the 39-year period. So we went from having it be a repairs, where a lot of people were doing this as repairs, it's going to have to go over a much longer period of time. Now, again, there's some caveats for people that own rental properties. If they're small enough, they're under the criteria. Again, you just have to do it more often in a 10-year period. So our next slide on 19, I'm going to talk about 2014 tax law changes, again, effective for 2014. The repairs and maintenance and supplies were 2014. Now I'm going to talk about the health insurance part of what's needed in 2014. So I think we've heard enough about this, but everyone in 2014 must have minimum essential health insurance for all of 2014 because of the Obamacare tax, it's called the Affordable Care Act, or pay an additional tax. Our Supreme Court has determined this is not a penalty, it's additional tax. and it has to be at the bronze level coverage, which is Obamacare definition, for yourself and everyone in your household. Everyone in the household. So what does the household mean? The household means whoever is in the household if you're taking a deduction for. Okay? So if you've got people in your household you can't take a deduction for, they've got their own tax return. So you're dealing with yourself, your spouse, and your children, maybe your parents that are on your tax return. They all need to have this minimum essential health insurance coverage for all of 2014, at least at the bronze level or better per the Obamacare definitions, and Medicare counts. Okay, so if you've got people on Medicare that are in your household, you take a deduction for Medicare counts. Let's go on to slide 20. So a lot of people have heard about, okay, well, what's this additional tax? It never says, oh, it's $95 for 2014. Well, let's stop there. No, that's not it necessarily. It's the higher of $95 a person in the household, for $47.50 for children under 18, or 1% of the household income. So let's kind of take someone that makes $200,000. And there's two people in the household. Neither one has insurance. Okay, they didn't go out and get it. They didn't think they could afford it, or when they looked, it was just too expensive in their opinion, and they heard about the $95. They said, holy moly, let's just pay the $95. Well, now if we have to look at 1% of income, and their income is $200,000, that tax is going to be $2,000, not $95 a person. Now, let's think about that. $2,000. Could they have bought health insurance for a family of two for $2,000 for the year? Probably not, unless they were young and very healthy. So is it still reasonable based upon what they would have paid for insurance? Maybe. But how much more could the insurance have been, and at least they would have had insurance rather than throwing more tax money away? So what they're trying to do is get it to a point where people understand it's worth having the health insurance rather than paying this. And, it really depends on the household income as to whether that makes sense or not. But there is going to be people where they make $50,000 or $70,000 a year, and they think it's $95 a person, and it's not. If they make $50,000 a year, 1% is $500. It's not the $95. Now we're talking about some money that they probably weren't aware of, and when they do their tax return, is that going to be a surprise? There are exceptions, and people that are making $50,000 and have two people in the family, they probably went to the exchange or the marketplace to get their insurance because they are well within 400% of the poverty level, which is $13,000. Amazing, yes, $13,000. But if we multiply that by 400%, we get a lot larger dollar amount that lets them to go out there. And the more people in the household, the more benefit they're going to get in credits. But they need to be aware if anyone bought their insurance on the exchanges of the marketplace, there is a form coming out in January called a 1095 form. And it has all the information about buying from the marketplace or the exchange that you must have to include on your tax return, or you will be getting these additional taxes. Okay, let's go on to slide 21. So what I just talked about is please be aware of this form that's going to come out if you did buy insurance on the exchange or the marketplace, because it has all the information you need to give to your tax preparer. Slide 22. This is an issue for businesses. So if you have a business, S corporation, doesn't matter. If you have a business where you are not mandated to have insurance for your employees, and you decided to give your employees money so they could go buy their own health insurance, or you reimbursed them to go and buy their own health insurance, you are now under, I'm on slide 22. My apologies. Where people that bought insurance on the marketplace or the exchanges are going to get a form in January called the 1095 form. If you didn't buy it on the marketplace or the exchange, there's no documents coming that says, I have insurance. and the IRS gets a copy of, and it proves that you have insurance so you don't get the additional tax. It's going to be an on your honor system. There is a place to say, yes, I had insurance, and yes, I had it for the whole year, and you mark a box. So it's an on your honor system, but I just wanted to point out that when you sign your tax return or provide the e-file forms for your tax preparer to e-file for you, you are signing under penalty of perjury that everything was true and correct on your tax return. So be aware that if you just say, yep, I'm going to mark that box, if you don't end up having insurance and somehow there is some information that will come out, there are going to be bigger penalties for having marked that box when you didn't have it. Okay, just want to make you aware of that, is that you aren't getting too far by just marking the box. At some point, all this information will be shared with the IRS, and there will be a matching. So let's go on to 23. So 23 is about S corporations, where the S corporation pays for or pays on the behalf of the more than 2% owner of the S corporation, pays for their health insurance. For many, many years, until 2014, we have been able to put that information on what's called the K-1. That's the form that is used by your tax preparer to identify that and put it on your personal return and give you the tax deduction for the health insurance, because you're basically self-employed with your business. No more. No more can that be done. So 2014, we have found out that the Department of Labor and the IRS have said, we won't allow it to be on this K-1 form. If you are more than a 2% shareholder of an S corporation and you have had your business pay your health insurance or reimburse you for it, it better be on your W-2. It better be in wages. It better be in the box on the W-2 that says health insurance provided by my employer. And then the box mark that you're more than a 2% S corporation shareholder on your tax return. That is the absolute only way you're going to get the deduction for self-employed health insurance. And this can be a big deduction. I have seen it as high as $23,000. It can be a very large deduction you don't want to miss. Okay, let's go to slide 24. This is what I started to talk about a little earlier, so I'm going to say it now. This is for businesses where you are not mandated to have insurance because you have fewer employees in the mandate, but you choose not to go get a group insurance plan. Okay, you choose not to have that. You choose to give your employees money so they can go buy their own insurance. Well, the Department of Labor and the IRS have come out recently last month and said, if you are doing this, if you are giving your employees money or reimbursing them dollars so that they are buying their own health insurance, you have an illegal health insurance plan for the Affordable Care Act for Obamacare. So in the last month or so, they have come out and said this is an illegal health insurance plan for the Affordable Care Act. You can't do this. Any money or reimbursements that you've given the employees so they can buy their own health insurance has got to be in their wages on their W-2 for 2014. So whatever you've paid them, and we'll pay them by the end of the year, must be part of the wages on their W-2. So let's go to slide 25. Let's talk about how you do this. So you have to add up all the money you've given your employees for purchasing their own health insurance or reimbursements, and you have to figure out what you're still going to do for the end of the year, and you need to include it in a separate payroll item, okay? Now, this does not mean that your employees are reimbursing you for their portion of a group insurance plan. If you have a group insurance plan, this is not what this is. This is where you have no group insurance plan for the office, no insurance plan, health insurance plan for the office, and you're giving your employees money to go buy their own. That's what this is. Okay, let's go to slide 26. So how do we do this? We add up all the money we've already given them, and we add up all the money that they're going to do for the end of the year, and it's a separate payroll item for each employee you give this money to. It's a separate payroll item for each of the employees where you're giving them money to do this. They've already got the money, so they don't need a net check. Okay, so it's really for the past tense. Anything that you're still going to give them, just add it to wages as you go. But anything you've already done, they've already got the money. They don't get a check. The money you gave them is the net check. Okay, let's go on to the next slide, slide 27. You tell your payroll company, this is the net check I gave them. I need you to gross this up because I have to pay the payroll taxes. Yes, guess what? What you gave them isn't all that you're paying on their behalf. You now are going to pay the payroll taxes on this. So you tell them this was the net check. They already got it. I need you to gross it up because I've got to pay the payroll taxes on this. Okay? So that's how you effectively do that. Any money you haven't given them yet, you just add it to their payroll for that pay period as additional wages to them. Okay. I know, confusing. I know it's late in the year. We have no control over when the Department of Labor and the IRS make these final decisions, but they did, and here's what we have to deal with. So take a deep breath here. So this other item I've got here on slide 27, it's not new tax law, but I can tell you the IRS is forcefully really going after this. We all take deduction for using our auto in our business. In order to be able to get any deduction for using our auto in our business, we're required to keep track of the total mileage on that car and the total business miles that we have on that car. You've got to keep what's called an auto log. And it's supposed to be contemporaneous, meaning you do it as you go, not you do it if you get audited. And the reason I'm saying this is that I've got doctors under audit, and the very first question the IRS agent asks is, where's the auto log when they come out? And if you say, I don't have it yet, they already put up their antenna saying they haven't done it. They're recreating it. And recreating it is not contemporaneous, and the tax courts are not happy with not doing it as you go. So I'm going to let you know it's important. I have auto logs in my lobby. I have them available for all my clients. You need to take this seriously because we don't use our cars 100% for business. We're not keeping track of the personal stuff. You need to start keeping track of the business expenses. Okay, slide 28. We've talked about some tax planning, home office. We've talked about some credits. We've talked about how to make sure meals are business employee benefits and not meals, and where you get a 50% reduction. We've talked about making purchases at the end of the year to take the deduction, the $179 at $25,000 this year. If you want to put things on your credit cards, if you want to buy a car. So we've talked about those. We've talked about the new tax law changes on supplies, repairs, and maintenance. Now all this stuff around essential health coverage and how we have to deal with employees if we gave them money to go buy insurance. It's just money. It's got to be wages. And getting ourselves our health insurance deduction if we're a desk corporation. So we've talked about a lot of things. What I'm going to finish with here is red flags from the IRS. So things that can hit your tax return that absolutely are going to be an audit flag for the IRS. Okay, this is where they want to audit and are auditing, and they're letting us know, if you do these things, we're going to audit you. So the first one on slide 28 is, if you're a sole proprietor, you're not incorporated, okay, so you're getting an independent contractor money, but you don't have any. You've got expenses. So it's where you haven't yet received money, but yet you're taking expenses for the business. It's going to be a red flag for the audit, and not necessarily for the first year, but if you keep doing it, or if these expenses, which create a loss because you have no income, are high. There are some that, they're $3,000 and they get curious for it. There's some that they're $30,000 in the loss and the expenses with no income and they get curious about. They're just letting you know you're running a risk if you have no income from your business, but you've got a lot of expenses. So be aware of that. So on slide 29, the other thing that is hot red flag for them is a personal service S corporation. This is an S corporation where it is a doctor, a dentist, an architect. It's anyone that performs personal services. You individually have to do the work, and you don't put a salary on the tax return for the S corporation for salary of officer. Hot red flag for the IRS. If you are a personal service corporation and you don't pay yourself a salary as an officer, you want all of the profits to not have payroll taxes on it, red flag. The next item, no auto log. I've talked about that. I can't say it enough. We've got to keep track. Number 4, talked about this before, but I want to say it again. No documentation on the meal of who attended and why it was business. No meal expense deduction. If we don't put on the receipt and keep the receipts, or when your statement comes from the credit card company, who was there, why it was a business purpose, what you discussed, there's no way you're going to get a deduction for that meal. You have to prove in some documentation who was there and why it was business related. So documentation is so important. And slide 30, my final point for this session, you must begin assessing where you are right now and working with your CPA to plan before year end. We have a month left. I know it's not a lot of time, but it's enough time to make some kind of an implant, but you've got to know where you are right now. And so you're not surprised April 15th. Get an idea of where you stand now. I always suggest you come in at least once, if not twice during the year, to meet with your CPA if you've got a business, so you know where it is and you know what to plan and some things that you can do before the end of the year to really make an imprint on retirement plan for yourself versus taxes going to the government. It's so critical. And what else you can do for your business that you might do this year that you might have been thinking you'd do next year that make a better impact this year. So that's what I have for you tonight. I hope you find it helpful. If you have any questions, you can reach me by email or by telephone. Email is best, and my email is mrebella, spelled Mrebella, at Rebella, Rebella, CPA.com. And our phone number in the office is 714-619-0667, 714-619-0667. If you're my clients, please let me know if you have questions. If you're not my clients, I'd be happy to talk to you about some of these things and really suggest you make an appointment and come in. So thank you so much, everyone, tonight. Thank you, Jeff.
Thank you, Monica. I appreciate you being on the call. And let me open up the lines really quick to see if we have any questions. If you're listening on the webcast, you can submit a question by typing your question in the box on the bottom left-hand side and click on the Submit Your Question button, and that will come through. And again, the phone lines are open, so if you have a question, just say something. And Monica, while I'm stalling to see if we have any questions, real quick, what's your sense of the IRS in terms of starting tax season, I guess, on time? I remember 2 years ago, I think that they delayed something. Is your sense that everything's on schedule for 2015?
Yeah, interesting. You brought that up. No, the IRS has announced that they will be delayed this year. They had suspected that Congress would act and extend a lot of these items, and Congress has not. So they will be spending a lot of time redoing forms that they did not think that you were going to have to do, and they've told us that they were not going to have the forms, and tax season is going to be delayed until February. So people with very simple returns aren't going to be able to get the returns done in January. They're going to be able to start until February. What's happened in the past when the IRS does this is that they phase in the ability to start tax returns. So they say, if you just have a W-2, you can start them on this date. If you have a W-2 and you have mortgage interest, you could start them on this date. If you have a W-2 and you have these other things, you start them on these dates. So they start phasing in when their forms have been updated and when they've got them to the various electronic tax preparer for companies, whether it's Intuit, TurboTax, Lacert, whatever the different companies are. It's when the IRS has finished the forms and when the tax services have been able to assimilate, bring in those changes into their tax software. So, for instance, last year we were delayed. And most of my clients were not able to we couldn't even start processing until about the 20th of February last year. And we expect the same this year. So it's going to be a delayed tax season. But guess what? It's still April 15th is the deadline.
Right.
So we have to start later, but they are not extending the deadline. It's still April 15th.
Okay, well, that's good to know then. Well, we do not. I don't hear any questions on the phone, and we don't have any questions coming through the internet. So again, great job. A lot of good information. Because it's right before Thanksgiving here as we record this call live, I think it might be worthwhile to mention two things. One, I believe we're not having a December call just because it's going to be the holidays around this time next month. And then our next call will be at the end of January. But you've got an event coming up kind of before then for dentists, and I wondered if it'd be worthwhile in the last 2 minutes to mention the Anita York event on January 23rd.
You know, I'm very, very happy you mentioned that, Jeff. Thank you for reminding me of that. Yes, in California, our governor has decided that we need to compensate our employees for sick time beginning January 2015. It's a complicated law. It has been written poorly from all the attorneys I've talked to about it, and they expect that there's still going to be some changes to it here before the end of the year. So knowing that we've got a big change in what we have to do as far as providing sick pay now to our employees, if you haven't before, including part-time employees, I mean, it's going to affect part-time employees as you may already give it to your full-time employees. We do have an employment law update for dentists, and it's the dentists only. Do not send your staff. Do not send your office manager. It's for the doctors only. And we are going to be having that in January. It's going to be January the 17th of 2015. And I do suggest that you all come. You do need to register. So if you haven't received the flyer already from me or the email that we sent out about this, please let me know and we'll get it out to you because you do need to register for it. The attorney's name who specializes in employment law for employment law for dentists. She works with a lot of dentists day in and day out on these issues. Her name is Anita York. She is the attorney doing this, and many people already know Anita from attending other employment law updates. So, please make sure that you put it on your calendar. Again, it's going to be, I misspoke, it's going to be Friday, January 16th of 2015. January 16th, it's Friday. It's going to be 9 o'clock in the morning till 1. And we do hope that you attend because this new labor law issue around sick time, as well as many other things about paying our people in the dental practices and our business is going to be important. So thank you for reminding me, Jeff, and letting everybody know about that.
You're quite welcome. And if you're listening to this call on Monica's website, we'll put a link down below this video where you can download the PDF flyer, or if you're listening on YouTube, there'll be a link where you can download the flyer with more information in the description box. So just scroll down and you can find that there. So Monica, again, thank you very much. Happy Thanksgiving. And for everybody that's listening live or on the internet, we hope to talk to you soon. If you have any questions, just contact Monica at the office.
Thank you, Jeff. Happy Thanksgiving to you, and thank you for staying so late tonight. Take care. Bye-bye.
You're quite welcome. Good night. Bye-bye, everybody.